When most people look at Elon Musk, they see rockets, electric cars, satellites, and bold promises about the future. But behind every factory, every launch, and every new product announcement lies something far more powerful than engineering: capital markets. Musk's true advantage isn't just innovation, it's his ability to use public markets, private equity, debt financing, and valuation psychology to fund expansion at a scale that overwhelms competitors. The real engine behind his empire is financial architecture. Capital markets are the systems where companies raise money from investors. This includes stock markets, bond markets, and private funding rounds. Most CEOs treat capital markets as support tools. Musk treats them as strategic weapons. Through Tesla Inc., he demonstrated how market valuation can be transformed into industrial dominance. Tesla was not profitable in its early years, yet its stock price surged dramatically. High valuation meant Tesla could issue new shares and raise billions of dollars without taking on crushing debt. Essentially, investor optimism became fuel for factory construction, battery research, and global expansion. This is a crucial financial concept: equity financing. When a company's stock price is high, issuing new shares brings in large amounts of capital while diluting existing ownership only slightly. Tesla repeatedly topped market equities during periods of strong investor enthusiasm. Each capital raise strengthened its balance sheet. That cash built gigafactories, expanded production capacity, and funded research into autonomous driving. Competitors relying only on internal cash flow couldn't match that speed. Musk wasn't just building cars, he was converting market confidence directly into physical infrastructure. Valuation itself became a strategic asset. Tesla's market capitalization at times exceeded that of traditional automakers combined. Whether justified or not, this valuation created leverage. Suppliers, lenders, and partners saw Tesla as financially strong because markets believed in its future. High valuation lowers borrowing costs, improves negotiation power, and increases investor patience. Musk understood that narrative influences valuation, and valuation influences capital access. In modern finance, perception can lower the cost of capital dramatically. Another financial tool Musk uses is debt markets. Companies can raise money by issuing bonds or taking structured loans. Tesla, once seen as risky, gradually gained access to cheaper debt financing as its valuation climbed. Lower borrowing costs mean expansion becomes cheaper. Debt allows a company to invest now and repay later, ideally from future profits. Used strategically, debt amplifies growth. Used poorly, it creates collapse. Musk balances equity and debt carefully, often raising equity when valuations are high and debt when confidence stabilizes. Musk has also used personal financial leverage tied to stock ownership. Much of his wealth is concentrated in shares of Tesla and other ventures like SpaceX. Instead of selling large amounts of stock outright, he has at times used shares as collateral to secure loans. This allows access to liquidity without immediately reducing ownership stakes. In high finance, this is common among ultra-wealthy founders. It preserves control while unlocking capital for new ventures or acquisitions. Ownership remains intact, influence remains intact, yet financial flexibility increases. SpaceX operates differently because it is privately held. Instead of public stock offerings, it raises funds through private equity rounds. Investors buy stakes at negotiated valuations. As SpaceX's valuation rose into the tens of billions, each funding round brought massive injections of capital. Private markets can sometimes be even more flexible than public markets. They allow long-term bets without quarterly earnings pressure. Musk uses public markets for Tesla's scale and private markets for SpaceX's innovation pace. This dual structure spreads financial risk while maximizing funding channels. One of the most overlooked financial advantages Musk has leveraged is government funding alignment. SpaceX has secured major contracts from NASA and U.S. defense agencies. These contracts provide predictable revenue streams that reduce investor risk perception. Lower risk perception increases valuation, higher valuation improves capital access. Tesla has benefited from electric vehicle subsidies and renewable energy incentives. When government policy aligns with corporate mission, financing becomes easier because future demand appears politically supported. This alignment acts like a financial stabilizer. Capital markets also provide optionality. Optionality in finance means maintaining the ability to raise funds quickly when opportunity arises. Tesla's strong valuation allowed it to raise billions in short windows of market strength. That optionality creates strategic flexibility. If a new battery breakthrough appears, funding can be secured. If a factory expansion is needed, capital can be deployed. Companies without this flexibility often miss growth cycles because they lack immediate financing access. Investor psychology plays a major role in this system. Markets price not only present performance, but future expectations. Musk excels at projecting long-term visions, autonomous fleets, global satellite internet through Starlink, AI integration, robotics. Whether or not timelines shift, the scale of ambition attracts growth-focused investors. Growth investors tolerate volatility in exchange for potential exponential returns. That tolerance provides Musk breathing room. While traditional firms focus on steady profits, Musk's firms focus on narrative-driven expansion supported by equity markets. Another powerful financial dimension is index inclusion. When Tesla joined major stock indices like the S&P 500, passive investment funds were required to purchase shares automatically. This created additional demand independent of daily news. Increased demand stabilizes valuation. Stable valuation strengthens balance sheets. Balance sheets support borrowing capacity. This chain reaction illustrates how capital markets create reinforcing loops once a company reaches scale. Musk's approach also benefits from retail investor participation. Individual investors, empowered by digital trading platforms, became major supporters of Tesla stock. Retail enthusiasm increases trading volume and volatility, but also expands liquidity. High liquidity makes it easier for large institutions to invest without dramatically moving price. Liquidity reduces capital friction. Reduced friction accelerates fundraising potential. There's also the strategic use of secondary offerings. When market conditions are favorable, issuing new shares can feel counterintuitive because it dilutes ownership. But if raised capital generates growth exceeding dilution, long-term value increases. Musk repeatedly used favorable stock surges to strengthen Tesla's cash reserves. Critics argued dilution hurt shareholders. Supporters noted that those funds financed global expansion that later boosted revenue. In finance, timing matters more than ideology. SpaceX's valuation strategy demonstrates another layer. By conducting periodic funding rounds at higher valuations, the company continuously resets investor perception upward. Each higher valuation reflects anticipated growth. That perceived growth justifies further funding at attractive terms. Unlike public companies exposed to daily price swings, private valuations adjust in controlled increments, allowing narrative management between rounds. Risk management is embedded in this structure. By spreading funding across equity, debt, government contracts, and private capital, Musk avoids reliance on a single source. Diversified capital access reduces vulnerability during downturns. During market corrections, strong cash reserves built during bullish phases act as buffers. This counter-cyclical preparation is fundamental in capital-intensive industries like automotive and aerospace. Critically, Musk's approach transforms volatility into advantage. Rapid stock price increases allow capital races. Market skepticism sometimes triggers short squeezes, increasing upward price pressure. High volatility attracts traders, increasing liquidity. Liquidity supports institutional participation. Participation supports valuation. Volatility, often feared, becomes part of the capital ecosystem. Ultimately, controlling industries in the modern era doesn't require owning every competitor. It requires controlling access to capital. Musk doesn't need to outspend traditional automakers from profits alone. He outscales them by converting investor belief into billions of dollars faster than they can internally generate cash. Capital markets act as force multipliers. They turn narrative into funding, funding into factories, factories into products, and products into market share. This is the financial blueprint behind the empire. Rockets and electric vehicles are visible outcomes. The real machinery operates in stock exchanges, private funding rounds, bond markets, and government contract pipelines. Musk's genius lies not only in engineering ambition, but in understanding that modern industrial dominance is financed before it is manufactured. In the end, Elon Musk's control across industries is less about owning everything and more about financing everything. By mastering equity timing, leveraging valuation psychology, aligning with government incentives, balancing debt intelligently, and maintaining optionality and capital access, he built a system where markets continuously fund expansion. Capital markets don't just support his empire, they power it.